Hi friends, welcome back. Today we have another guest. I invited my friend to the channel. His name is Steven. So he'll be with us doing some chit chat on investing, on journey to become a better investor and so on. So welcome to the channel, Steven.
Thank you very much. Thank you for inviting me to your channel. I appreciate it. Yeah.
Okay. So can you just give some introduction about yourself? Because I believe I think this is the first time you appear on my channel. You were interviewed by other YouTubers before, but for me it's the first time, right? So can you please give us a brief introduction?
Okay. So I'm 40 this year. I'm an engineer, trained and is working as an engineer for about 20 plus years. So yeah, I have 2 kids, and so yeah, that's about me lah. So nothing really fascinating. I don't work in the finance world or anything like that. So I picked up investing, like say seriously investing a couple of years ago. But I started investing actually it's about just before the global financial crisis in 06, 07. Then after that, then I stopped for a couple of years due to family commitments and all that. Then it's somewhere around 1.7 or 1.8 there about that I went seriously deep into investing and learning from books, from talking to other people like yourself, and and then went deep dive into the rabbit hole is what also you will say. Yeah.
So today's topic, we're not going to talk details about specific stocks or anything like that. It's just more like a broad introduction, broad and general investing, right? So I think the first question that I want to pose to you is that, when we talk about investing, most people will talk about like the how, right? Like, I'm investing this is how I do, this is how I trade, that kind of things. But I think if we take a step back, we will want to ask ourselves, like, actually, why are we investing? What's the purpose actually? So my question to you is that, okay, when you think about investing, actually, what's the purpose in your mind? Like, is it for retirement, for kids, or really just to enjoy your life? Anything like that? Just want to hear your comment.
So for me, I think when most people start investing, including myself, right, when during the just before the global financial crisis, a lot of us, at least for me then, was to try and make a big buck. For example, today I sell. Today I buy a particular counter, and hopefully it surges 20%. I'll sell the next day, next week. So that was my intention then, or close to 15 years ago. So as we grow through life experiences, we learn many things. So some good, some bad. So I think it's for me, through those experiences, for me for now, right, it will be more towards for retirement, more for leaving a legacy or some generational wealth for my kids. So hopefully this will help them in the future, because I see that the future is evolving very quickly nowadays, and technology, it evolves super fast, and I'm not sure whether my kids can need help in those areas where they want to pursue certain things, but are not paid as high as they would want to. So that will be the part for my kids. So with this horizon, with this thinking, right, that will say at least a decade away from now. I'm not about 40, so at least a decade when I'm 50 or 55 years old, then probably I might need the cash. If not, then I can still let it snowball. So back to your question about why investing. So to sum it up, it's more for retirement for my kids, and hopefully if I can accumulate that amount of wealth sooner, I can probably do the things that I want, and have, like I always said, to have more options in life, because money actually gives you option in life to do the things that you want. And it is, I believe, I believe that this is the greatest dividend that the money can give you, the freedom to do what you want, when you want, how you want. Yeah.
Just now you speak of leaving a legacy to the children and for the next generations, right? And I think for Chinese, right, usually I would say most people would say, okay, we'll just buy houses and then pass down the houses, right? I mean the properties. But I think if we look at the broad asset class, of course, real estate is one big asset class, and then aside from that financial asset class, we have like equities, or even we have some FD. There are parents who pass down FD to their kids one. So I think those are also kind of like popular, especially among Chinese now. So in your view, when we think about this legacy or pass down the wealth or something that I mean like a safety for the next generation, right? What asset class is your main focus, and why is it you choose that asset class, or do you like have a more balanced kind of approach?
I think for Chinese in general, right, we love property. That is generally true. But from my standpoint, property is it is something that has no productive value. That means it doesn't generate cash flow unless you're renting out a room or apartment. So basically, as what Robert Kiyosaki would say, that as long as something that doesn't generate cash flow, it is basically a liability. So I tend to steer towards that thought, that train of thought, and I would think that I would leave my current house for my kids. When I pass on, my wife and I will leave the house for them, but I will not buy a property for them per se, or even buy. Let's say I have 2 kids, so I will not buy, let's say, another 2 property for my kids. Anyway, I don't have the capacity to do that now, but I wouldn't do that because I would think that property is highly leveraged. And yes, you will make money in the long term, but the returns are not as high as, let's say, equity, for example. But I do agree equity comes with higher risk than property, let's say in Singapore, which generally is rising, let's say 3 to 5% a year capital gain. So that's my stand towards property. I think, but if I have a lot of cash, like I'm a multi-millionaire, right? There's no harm like investing 1 mil or 2 mil into property. But if let's say I only have let's say 500K, for example, and I'm going to buy a 1.5K, let's say private property, I'm going to leverage about 1 mil. So that the part on the leverage is something that I'm not comfortable with, because as you know, for now with the interest rate rising, right, perhaps a 1% increase in interest rate probably amount to say about 1,000 or close to 1,000 per month interest on top of what you're paying. So that is pretty scary. So that is why I don't leverage in terms of property, and also as equity as well, I don't do leverage. So my brokerage are all my investment brokerage are all cash account. So I don't have a margin except for one which I do some quick option last time. Other than that, for investment account, I don't have leverage. Then the next part, to answer the next part of your question, is that I would generally be more inclined towards equity, because I think that equity is a way of owning a company. So in fact, it is, but most people would think that it's just a number that jumps up and down on the on the stock exchange or the market. Yeah. So this is I think we have to look behind the numbers that jumping up and down, including the volatility of certain stocks with high beta and all that. So that is what I'm looking at, owning a part of a business. And then thereafter, right, when we buy that particular counter, we have to look at the business, whether the business is doing well or not. And this is very subjective, and some people would say that the macro dictates the business. Some would say ignore the macro and think long term. So I wouldn't say that who is right, who is wrong. It depends on the perspective. And I think that the perspective comes from your life experience throughout your life as you grow, and the education that is imparted down from your parents. That would influence the thinking. And if there are certain parts. Okay, so coming back to this, so for example, right, for us, I think our parents' generation, if we are from an average income family, would be telling us to save more, and for a raining day, and somehow through the television that we watched when we were young, right, we were taught that actually the rich are very evil, and don't be rich, because you think you become very evil. All the television drama series that we used to watch on Channel 8 and all that. So all this are, I would say that you need a shift in your mindset to think that actually the rich are not evil. Not say that means that when you have money, right, it doesn't automatically turn you into an evil person or someone who's bad. Money to me is just an amplifier. So if you are a good person, you want to help people, the money, if you gain rich through whatever means, you will use that money to help people through various means, like you can donation and all that. But if you are an evil person, or we say that you are a greedy person, you would want to always take advantage of somebody. Then when you become rich, right, that thing will be amplified even bigger. So that is the change in the mindset that I thought is important. Yeah, and yeah, so that's about it. Yeah.
Speaking of money, right? And speaking of, let's say, just now we talk about the retirement. There's always these like magic numbers, right? That people always talk about. For example, like those who say the 4% withdrawal rule. They say you save up. As long as you just draw 4% from your portfolio, then you can basically retire or even retire early, right? So do you, like, when you plan for your own retirement, do you have a specific target amount? And let's say if you have or you don't have, right? How do you think about like achieving this target amount?
So the targeted amount for me would be, let's say, I think for most people would just take the let's say expenses per month, then you multiply by, let's say, 12, you get a year. Let's say, and then you multiply by the years that you're going to live in retirement. So let's say 1 month, if I need, let's say, 3,000, then a year I will need 36,000. Then let's say if I'm going to, let's say 36,000 off to 40,000. Then if let's say I'm going to retire at, let's say retire at 50, I'm going to live to 90. That's about 40 years. So 40 years times the 40 is about 1.6 million. So that will roughly be the number that if what I'm looking at, if my basic is my expenses is about 3,000 a month, and then you got to factor in inflation and all that. So ballpark, maybe 2 mil will be very comfortable with let's say if I were to factor in vacation and all that. That would be how to actually reach that amount. So let's say, for example, let's put it 1 mil. Let's say if I do 1 mil for easy calculation. So 1 mil, if you then you have to calculate how much you need to get the 1 mil, how much returns you need to get a 1 mil. So for example, if you aim for a 10% return a year, that would roughly be compounding at every 7 years. So let's say if I take 20%, that will compound roughly about 3.5 years. That's down to 3 years, right? So 3 years. So if let's say I have 100K now, and I finally managed to find a 20% CAGR returns per year, so it will double every 3 years. So for about 9 years, it will triple. So for 100 to 200 to 400 to 800. So it's about 800K in roughly about 9 years plus 10 years. So that's close to a mil. But that's excluding further injection of funds. Yeah, so that is roughly how I think we should actually, or rather how I calculate all this, and to have a sense. So I think this is important in the sense that you should know roughly how much return you are looking at. So if let's say we are looking at 30 or 40% a year, right? Then we are, I think we are taking very high risk, because you'll be looking at something, I don't know, like maybe crypto that might give you 40%, 50% a year, but that might not be many years, maybe 1 year. But you could have lost your money, in a year or two, with all the crypto issues going on, with the recent, the Luna a few months ago, and now the FTX with issues going on. So I think we have to be realistic and look at what are the probable chance of getting such a return. So I mean, everyone we know that actually the average if you invest in index fund, like let's say for example S&P 500, is yielding about 10% plus dividend there about 9-10%. So if you take 10%, you'll be compounding, you'll be doubling your money every 7 years. So then you work backwards, let's say 1 million, how many 7 years do you have to double your money, and then invest that accordingly? I think that would be a safer bet than to say, I want as much money as possible for retirement. I think that is a very dangerous statement to make, because you will aim for the sky, and by aiming for the sky, you are taking probably unnecessary risk, which you could reach in, let's say, earlier, but you are actually increasing your chance of losing everything as well.
Yeah, just now you mentioned about these return expectations, right? I was thinking like, we talk about like, let's say passive investment, S&P 500, 10%, and then some high growth companies, some will actually assume they are going to grow at 20%. And then even the super high growth, and if you're lucky, you strike the correct companies. I mean, 40% for a single company, definitely they are companies that achieve this kind of record now. But it's just that for us, right, we are planning for, like our retirement. And this one, we are not talking about like specific companies, right? We're talking about like overall portfolio. Do you think like, let's say, assuming like a 20% return for a fairly long period of time, right? Like we're talking about, let's say 10, 15, 20 years kind of horizon, right? Like even Warren Buffett, I think his record only somewhere between 20 to 25%, but his record is very special because this is not like a 10 years records, right? His one is like decades of returns, but yet he's getting like, like 20+% and it's already like godlike level. So do you think that it is realistic for us to assume even like, let's say 20%, or some will even say that even 15% is like very optimistic already. Well, how do you like reconcile like a different assumptions of return, and what's your own expectation with regards to your own results, and like when what kind of assumption that you use for yourself?
Okay, so earlier I talked, let's say they mentioned about 20% a year. So the other thing is about if we were to expect a X percentage return a year, let's say 20%, right? We have to be very aware that we will not get 20% a year every year. So that is the average, let's say, spread across 10, 20 years. So that's one. The other thing is that is it possible to get 20% a year for, I don't know, 10, 20 years? This is very hard to predict. I think nobody can really, I can't tell you that I will get X number of return for 1 year, 5 years, or 10 years. I think that no one can really tell. So what we can do is that we can make educated guesses. We can do a probabilistic way of looking at things. So for example, you are looking at a company, for example, that is not growing and is giving out dividend, for example, and the dividend is, let's say, 4% a year. So we are kind of like high chance of that company returns of about 4 to 5%, maybe some capital gain, 7% a year, that kind of thing. Yeah, so that is a high chance. So if you look at growth stock, for example, right now I don't know whether it's an in thing now for growth stock or not, because last year it was the in thing in growth stock. Everybody said let's go into growth stock and forget about value stocks and all that. But apparently there's some shift when I read some comments. Everybody's like shifting back to value stocks instead of growth stock. Which is good, which is bad. I mean, I can't really tell, but I think that then we have to look at, let's say, growth stock. The company is growing at, let's say, 20% a year. And if we buy the company, let's say, at fair value, okay, and then we kind of like have a high certainty or high probability that the company will return, let's say, 20% a year of value, not price. So value we can kind of like guesstimate, but price is something that is in short term is driven by market sentiment. So what the Fed is going to do, what Elon Musk is going to tweet, what he's going to do, what the government is going to do, like what China government is going to do. These are things that we cannot control and cannot predict. So I am more of a bottom up investor. Not saying that top down is wrong. No. I think everybody has their own preference. So I'm a bottom up investor. So whatever I look at the company fundamental first, and the fundamental is good. The management is good. There's a moat, and there is a growth in the industry, or there are a lot of circular tailwinds that are incoming, and the risk is manageable. Then I will finally look at the valuation. So the valuation for me will come last. And if the valuation of the company is overvalued, then I have to make a stand on how overvalued am I comfortable to take, and what is the growth. Because a lot of people, there are people who use traditional valuation, simple traditional relative valuation like PE, PB, PS and all that. So then some would talk about PG, price earning with growth. I think this is coined by Peter Lynch. So if you take the PE divided by the growth, let's say the PE is, let's say, for certain company, let's say is 70 PE, but it's growing at, let's say, 70%, right? So the PEG is actually essentially 1. So that is like a fair value in that sense. So again, I think valuation is very subjective. And I also think that it is very important to do the valuation yourself, because I realize that a lot of people would borrow their conviction from others, and they'll just parrot their others' valuation and method and all that. So that is okay in a bull market. But when it's in a bear market like now, right, it is very dangerous, because when you borrow conviction, if that person or that YouTuber, right, would change his stand And so what are you going to do? Are you going to follow him or her? But then his situation and yours is different. He could have millions of dollars, but you could have leverage in or all in already. So that is very dangerous when you do borrowed conviction. And coming to the valuation part, so like I said, everybody valuation is different. So, but when you do it yourself, you have a range of number to cling to. So, for example, for this particular company, let's say the valuation is 200 to 250, and it's now, let's say, around 200, in the middle 225. So, I would consider buying or not buying. I will consider. But if let's say it's $300, I definitely will not buy it. But if it drop to below 200, right, let's say 150, 170, right, I think that is a good deal. So that would trigger me to buy average in or average down, depending on all my cost basis. So that will give investors a number to cling on, to know when to buy, and to keep the investors sane, I think, to know, okay, it dropped, but it's still within my price range or undervalued. Then I have to relook at my investment thesis, which should come out before I buy the company. And then with that thesis, right, then I will know that, okay, the company fundamentally is still doing well. Eventually, it will go to mean or reversion to mean, and the company will, improve and all that. So that is my philosophy nowadays as a investor. Yeah, correct.
Just curious, right? Because I think in the past 6 months or so, maybe, okay, since this year, we are seeing that quite a number of companies actually, when you look at their results, their results is either still okay, but lower than last year, or some are actually showing kind of very horrible results, right? I can give you a couple of examples. Companies like Meta, suddenly free cash flow drop a lot because of their expenses go up, but revenue kind of stagnating, right? Then there are quite a number of other companies also have similar kind of situation. Some might actually blame it to the macro environment, recession, or the upcoming recessions, right? Even the companies that looks promising now could show some deterioration in their result, their financial result, their revenue, earnings, and so on, right? So from an investor perspective, how do you think that we can cope with this kind of news where we have a certain expectation, but sometimes, the result just doesn't turn out to be on par with our expectations, right? It could be lower, right? So how do you cope, let's say this kind of situation happen? And I'm sure that it will happen. It's just that which company it will happen to, right? So just want to hear your thought on this.
When we are invested, right? We're invested, when I say investing is long term, there are some people who take investing as like less than a year. My definition of investing is decades, so at least a decade. So that let's set that straight. And then when we invest in decades, right, there will be times whereby the results will be bad. It will not be a smooth sailing. Like let's say 20% year-on-year growth or 20% quarter-on-quarter growth. It will not happen if you are investing in decades. And within that decade, right, there is bound to be economic crisis. So there'll be a crisis within decades, I'm sure. I mean, like 20 years, 20, 30 years, there'll definitely be one, at least one or maybe a couple of that. So during a crisis, most company results will drop. I think there are some exceptions, but generally, yes, most will drop. So when most companies drop, right, then I think that's where the initial investment thesis come in. Whether is it a temporary or a permanent drop. So this is subjective, and it depends on the investor understanding of the company and its investing philosophy. My invested company, a company that I have invested, sure enough, it will drop. But I don't think for now, if you invested in companies with good balance sheet, at least with good balance sheet, I think this is very, very important. With good balance sheet, so company with good balance sheet will actually weather this through. And then if it has certain growth in certain sectors, that'll be good. So what is good balance sheet? So for a start, right, good balance sheet is a company that has a lot of cash and low or no debt. So basically net cash. So that's important because in a crisis, they might need to dig into their cash reserve, for example. And if they have like billions, you don't have to worry about them going bankrupt if, let's say, their bottom line or their cash flow is in questions, let's say losing millions a quarter or a year. They could probably last a couple of years. And typically an economic crisis would last 2, 3, 4, maybe max 4 years. I think on average it's about 2, 3 years. So if the company had lasted through that, and then they have sufficient cash, so during that period, right, and if it's still able to grow, that would be excellent. If it can't grow, it can actually start to acquire companies that have fallen and then make themselves bigger and turning themselves into a monopoly, and they have even higher pricing power. So you can see some examples slowly as we head towards, I think, towards a recession next year. So so the interesting part about recession is that actually we are on, I think the last few quarters, we're actually on a negative quarter to quarter. So technically it is classified as a technical recession. But the thing about recession is that it has to be declared by some government board in US. I think it's NBER or something like that. And they have yet to declare that. So technically we're in recession, but officially we are not. So does it matter? Actually, it doesn't really matter. So I think that we have to look at company fundamentals and see whether their financial are hit, which I think most are, including be it you are selling cars, be it you are selling food, restaurant, R&B, you are selling data companies, you are, in fact, I think most will be hit. And then it is actually kind of like worsened, right? Because for the past 2 years, we are in a pandemic. In the early part of the pandemic, in 2020, there was an influx of money from the Fed. I don't know how many trillions were thrown in, I think 10 over trillions or something like that. So there's an influx of money. And hence, I think a lot of companies' price were inflated. Right? So when it's inflated, a lot of people went in. And then when the money withdrawal, so-called, when the Fed reduced their balance sheet, and all these withdrawals start kind of like happening. So all these prices will start to drop. I think it's a natural process, which I think as bottom-up investors, we shouldn't really worry about that, but we should worry about whether the company can weather this through and whether the fundamentals are temporarily or permanently affected by all this. So I think that is the question that we have to ask ourselves when we're invested in many companies. So that also leads to the next point whereby when we are invested in too many companies, let's say 20, 30 companies, right? It's very hard to manage all this unless you are a full-time investor. If you are a retail investor like us, we have a day job and all that, it is very hard to monitor the earnings, because I think we have to actually look into, at least for me, I will listen to all their earning calls when they come out, read their quarterly report. I think that's the bare minimum I can do, right, as a retail investor, to do my DD, my due diligence on my company. So you have a 30, and then the earnings season of typically they come together, so all around the same couple of months. So I'm going to be very busy, so I can't do that. Maybe some can, and they have passion and interest into it, I'm sure. But I can't do that. So I will try not to invest in too many companies, and I try to know them well. So when the companies are fundamental are rocked by, let's say, crisis, or even some funny things that's going on in the news, especially in the mainstream media, where their objective on mainstream media is to draw our eyeballs to it. And it is to create some form of fear, uncertainty, and doubt so that we go and read that headlines. So I think that is important to differentiate, not to read too much of the news, be it during the bull market or bear market, because in the bull market, you'll feel, everything is going up, I should buy more. But in the bear market, everything is going down, all the news are coming in, crisis coming in, I don't know, like anything, like you can read the news nowadays, it's all bearish news. And that will affect the emotion of the investors, which is not good in my opinion, because as investing, we are supposed to be less emotion driven, and best is emotionless, but I think it's quite impossible to, and then to be more data driven and to be more to be calm, basically, right? So you see, like you mentioned earlier, investors like Warren Buffett, like Howard Marks, there are many more. I can't think of them right now. They are actually quite emotional towards investing, so they buy, and then if they make a mistake, like Warren Buffett, he claimed that he made a mistake, or he said that he made a mistake when he bought airlines and he sold somewhere during 2020. He kind of like, okay, I made a mistake, sell, move on. Don't hold on to a losing businesses and then hoping it will turn around. Yes, it will, but you lose that opportunity cost when you do that. So this is something that we can learn from great investors, which I like to read their books and understand their mindset and their thought process, which helps, because I think like we discussed previously, that I think investing is basically 80% mindset and psychology, but the rest of 20% is more of a technical, your knowledge that's critical. Yeah.
Investing is not just about like reaching the end goal, right? Of course, we want to reach the end goal, become a wealthy person, right? But the investing itself is like a journey. So everyone of us is not like, okay, I'm doing whatever that I'm doing today and just continue to do this exact same thing without improving myself, right? So there's this journey. Everyone will go through the journey of become a better investor. So my question to you is that what's your view? Like how do we become a better investor? Do you have any trick or any things that you practice or any framework that help you out with regards to like becoming a better investor?
As a retail investor, I think it helps me to be a better person. So what do I mean by that? Because I think as an investor, like I mentioned earlier, it's actually 80% psychology and mindset. That means, right, I have to have the right mindset, be it whether as an investor, as a person, or as an employee working in a 9 to 5 job. So, for example, for the first one, I would think growth mindset. So we need to have a growth mindset, be it in working. That means we have to be able to try new things. We have to be able to take failures. We have to be able to learn new things, and then to constantly ask ourselves or ask myself, what can go wrong? And to have that intellectual humility to know that we are always wrong and to be less wrong each time. So that would help me as a person when I, let's say, go to office and work, and I will ask myself when I make a statement, when I answer my colleague to let's say a technical question, I would think that I will not be so overly confident. I will think through and I say that based on, let's say, certain things, based on my experience as well, this would likely to be happen. I will also say that I will not say that I confirm this will happen. If not, then I will do this. This is something I did during my younger days, like when I was young, young and rash and brash and all that. You do all those funny things. But as I go through the years, as I learn my lessons through an investor, it actually helps me to be more self-aware as well, to know of my cognitive bias. So, for example, if I buy let's say if I invested in a particular company, and I know that we have this confirmation bias confirmation bias, we will look for news that would be true to our thesis, for example. So, for example, invested in this company A, so I'll look for news that is bullish to this company A, and any bearish news, I would think that it's not possible, it's not important, this is nonsense, this is But I learned that throughout the years not to do that. Take in those bearish theses and digest it and see whether it makes sense. If it doesn't make sense, I'll just throw it away. But if it makes sense, then go and find out whether it is important. And most of the time, right, when bearish news or bad thesis come out from others, right, it will bear certain element of truth. It will not be totally nonsense. So I have to take in and see what is the probability of that bearish portion happening, and have to reassess whether do I need to reduce my proportion of that company in my portfolio, or should I just hold on. So these are things that goes through an investor mind when we make decisions. So all these decisions actually move on from an investing mindset to a personal life, right? So the next thing I could think of right now off the top of my head, because actually this interview we didn't like prepare, it was more of a chit chat session. So whatever I share will be like off the top of my head. So the other thing I would think that is more of the emotional stability. So when we invest, like I mentioned earlier, we will see the stock price going up and down, up and down, up and down, right? So this actually affects emotion. And when you see a portfolio drops by, let's say, 50 to 80%, right? Most people would either, complain on certain Telegram group and all that. Some people would actually be very depressed, very withdrawn, and don't look at their portfolio. But for me, right, I would think that to level up as a next investor, right, we should actually open up the portfolio that rate 50, 60% down portfolio, look at it, and then ask ourselves, what is my feeling at this moment in time? What are my emotion at this moment in time? And then maybe write it down and then work on that. So, for example, if I feel fear, I'm going to become, the company is going bankrupt. I'm going to become bankrupt because I'm 100% in, for example. Then we should relook in ourselves and see that, hey, what went wrong? Is it the company? or is it myself? So most of the time, for example, if I'm all in a particular company, which is not advisable, maybe you can consider, let's say, reducing some of it, let's say to 80% instead of 100%. And to look at the emotion, for example, if let's say this particular stock has high beta, high volatility, right? Is this stock actually suitable for my character? Not every stock, or rather a particular stock is not suitable for everyone. For example, if I say high volatility, right, some can take it, some can't. So a good measure of it will be whether are you emotionally affected. And sometimes you cannot see yourself. You could ask your friends, your family members whether you are emotionally affected. And I think the other barometer would be whether can we actually sleep soundly at night. So for me, actually, I don't watch the stock market at night. So maybe, especially now, right, it reverts to 10:30, right? So I try to sleep for 10:30 and not look at it because I'm not going to be buying and selling because of that daily fluctuation. So basically, most of my trades or most of my buy right is more towards GTC. So it's good to cancel. I also set maybe months ago and I just set leave it there. If it hits, I buy. If it doesn't hit, I just leave it there. And I typically don't sell. I've not been selling anything for the past, I think, a year or so already. So even if I sold previous prior to that, it's more for like smaller position and more for consolidation into higher conviction stocks. Yeah, so that's hopefully that answer your question.
Yeah, I think that's a good comment. I try not to interrupt you because I think those are good comment, right? Once I interrupt later, disrupt your flow. So that will be my bad already. Actually, I just want to give a small comment with regards when you said about this emotional management, right? Because I remember I read some book years before, like they talk about like how to like something to do with anger management. So I think the trick is that, I think a very simple trick, which is simple but may not be easy, is that whenever you found that you're feeling angry, actually by just aware of that you are feeling angry, like the awareness that, okay, actually I realize I am angry, and just observe our own angriness inside, right? Just that awareness itself already able to calm ourselves down a lot already. I think this is true for, like fear situations or other kind of emotional, because when we get emotional, and usually we are not aware of that, but we are in that emotion. But once we are aware, right, then it becomes like how to say, it guide us towards better decisions making later. So I think that one is a good point. So I think we are kind of close to the end, but then just maybe like one more questions to ask you, right? Speaking of this circle of competence, right? I think every investor have different circle of competence. Some will tie it to, like your day job. For example, you are in certain industry, hence you should like invest within that industry because you know the inside out, right? So aside from this, there are other ways to tie it. It's like could be because of your background or your experience or just your circle of friends, anything like that, right? In your view, right, what's your like a circle of competence, and how do you leverage this circle of competence, the knowledge or this how to leverage your circle of competence in the investing?
Okay, so there are two thoughts here. So the first thought is invest within your circle of competence, the COC. The other thought would be more like expanding your COC. Invest within your COC. So for example, I'm an engineer, let's say doing like electronics, for example, So that would mean that I would invest in electronic companies because I understand them well, right? Or even semiconductor companies. But apparently I realized that most people don't invest in what they are doing because they know the industry well. So for example, I'm doing a bit of RF. So like RF will be related to like 5G in commercial companies for those who are not familiar. So I don't touch any electronic company. I don't touch 5G. I don't touch semiconductor because maybe it's just me. I'm not sure, but because I understand certain elements of things. Like for example, like that's a quick one. So for example, 5G. We're looking at 5G. 5G has actually three bands, or maybe two bands. One is sub 6 gig. One is above 6 gig. So for the usefulness of 5G is when they are above 6 gig, when they are higher bandwidth. So like, I can't remember the exact frequency band. So it's more than 6 gig. So the higher bandwidth means like the diameter of a pipe. So the bigger the bandwidth, the bigger the diameter of the pipe, where more water or more data can flow through. So the higher frequency band, right, actually has not been really implemented, from my understanding, nationwide, at least in Singapore and a large part of other countries as well. I think the challenge will be more of like, because as the bandwidth, as the frequency goes up, the wavelength becomes shorter. So C equals to F over lambda. So as the wavelength becomes shorter, which means that the distance of transmission is shorter, which relates to that the base station or the transmitter, right, has to be closer, which relates to that require more base station. That means, for example, now, right, one base station can cover 1 kilometer. So for 5G higher frequency, maybe one base station cover, for example, I can't remember, let's say 1 meter, for example. So you need more base station. That means the capex, right, to develop this 5G for the higher frequency band is actually very high. And I would think that companies, or rather only countries, cities can probably do that, not in suburbs where, it is not worthwhile for the population. Yeah, so that would be more of answering your question on the invest within a COC part for me. So then it comes to the second part on expanding your circle of competence or COC. So that would also means you need certain drive to do that. So for example, if I would notice a company that has a potential to grow, let's say, like we talk about high growth and maybe high returns. So then that person, let's say, have a high drive to do that, he or she or myself actually venture to deep dive into that particular industry. For example, maybe a car industry, AI industry, or maybe some robotics industry, to understand it better, because then you have the drive, and then that to expand your circle of competence, right? I think that would require reading a lot, and to talk to people in that industry. One observation I make is that in reading, or rather great investors, right, actually they do one thing very common, they read. So they read tons and tons and tons of books or annual report, like Warren Buffett. I don't know many hours he read a day, even at his age. So it's quite admirable for him to do that. So I think reading is important, and also reading a wide array of topics, wide discipline of topics. For example, for an investor, you could read psychology, which I do, and we read about investing, and I read about accounting and engineering. So it's a wide spectrum. And then when you have the wide spectrum of knowledge, right, you're able to connect the dots. And when you connect the dots, you're able to make a better decision which industry to be, like they say, coming on, or maybe whether this company will do well in this industry. That gives an extra edge. So by that, reading and talking to people in that particular industry would help expand the circle of competence, or COC for short.
I do totally agree with you with regards to, when you say people who are in that specific industry, usually avoiding that industry. So sometimes I'm kind of like wonder, is it because we are in a certain industry, so we see all the shits, all the bad stuff of the industry, so we kind of like lost interest to invest in them? Whereas, let's say when we invest in companies that's outside of our, the industry that we are working in, right, then we kind of like don't see the bad things, and we only hear about the good things, meaning the narratives. So I wonder how true it is. So this is just questions. Maybe we can explore that in the future sessions.
Sure.
So I think let's call to the end of today's show. Thanks a lot, Stephen, for coming to the channel and then sharing your insights. Really enjoy listening to you, sharing all these good insights. And you have anything to close the sessions? Anything to say?
Thank you for inviting me to this session. I think this is a very good session for us to like chit chat, and although it's me talking, maybe the next time you can share more about your perspective as well. So I think this is good, because actually it helps me to crystallize my thought, because some of the questions you asked, I wasn't prepared. I wasn't prepared or anyway. So it helped crystallize my thought, and then to actually help me to think through all these things, and to be better as a person, which I aim to be at least 1% better than myself yesterday, which I thought, that's my closing thought. Thank you.
We should aim that this episode is not just watched by our friends who are, subscribing to my channel or recommended to anyone, right? You'll be watched by your children as well. So we have to bear that in mind, right? Okay. I think let's close the sessions here. And thank you so much, Stephen, for coming. Let's do it in the future.
Thank you.
So we'll start the recording. Thank you. Thank you.
Bye-bye.
Bye.